Hello and welcome to the Dorsey Report for the week of February 23rd. We're going to jump right into things and talk a little bit about what we saw last week. The markets continue to rally to a nominally new high here, although the markets were only up between 0.5% and 1% for the week, with a huge short covering rally on Friday on the good news about a Greece settlement with the ECB and also resolution of the dock, shore workers, and shipping slow down on the West Coast. But you know what they typically say, buy the rumor and sell the good news. So it's possible that we'll see a bunch of the late Johnny-come-lately bulls dive right in on Monday, only to provide fuel for the smart money short sellers. So definitely want to be wary on that front. And also longer term, because we're seeing two very fundamental correlated indicators with the U.S. risk markets and economy, U.S. macro indicator and forward earnings, which are typically what stock prices are all about. However, those have diverged very severely to the downside since about last October. And since then, U.S. markets have really gone a bunch up to the upside. Even if these two were to meet halfway, you'd see the S&P back down into about the, call it 1970s. And if the S&P were to converge to the downside, we could see prices well below 1900, as low as the mid 1800s on the S&P 500. So fundamentally not looking so good there. Also very long term, we've got the 2001 peak, 2007 peak, and now our current massive 6+ year rally. Before the 2001 peak, we saw some serious negative RSI divergences during 1998 all the way through 2000. So that was a very long 2-3 year negative divergence while price continued to make higher highs. Momentum was not confirming that. Also in 2007, we got a much shorter non-confirmation. That one was just about a year of negative divergence, and then the markets finally made the huge break during the 2008-2009 meltdown. Also in 2011, going into the first debt ceiling crisis, we saw a, we'll call it 2-quarter non-confirmation of the RSI, and lo and behold, this year we're also getting into almost a year here, at least 3 quarters of negative divergence, so versus higher price highs. So that's definitely giving the lie to this current very bullish upside action we've seen. So again, bigger picture, things not looking so hot for the U.S. markets. A little bit shorter term, we have sort of a projected scenario here. We are still in a rising channel. However, our upside is very much constrained given last week's action. Looks like our upside is maybe 2120, so another 10 points, less than 0.5% to the upside. And yet the bottom of that channel is still down around 2030, maybe 2040 if we give it the month of March. So right now our risk reward is, call it 10 points to the upside and 80 points to the downside. That's not a very favorable ratio. To get bullish, we definitely need to see prices come back down into the lower 2000s. In terms of some cycles, we're definitely seeing some downward cycles here. And things are holding up okay on the short-term breadth. However, yeah, our long-term indicators are not confirming that. Very interesting tool that I came across too, thanks to Ella Connell on StockTwits, but just the Wall Street Journal's money flow tracking indicators. And basically shows major indexes, major stocks, major ETFs, based on the up-down ticks, what the daily inflows and outflows were. So I figured, hey, we'll give this a little swing and see what it tells us. So looking at the last few highs, major highs on the S&P, going back to December 5th, we saw a major high. On the money flows, what do you know, on the S&P 500 ETF SPY, we saw outflows of almost 300 million right there at the top. Then on our next major high over here on 12/29, December 12/29 last year, we saw, again, major outflows, the SPY leading the pack of almost $450 million. Next major high here, kind of a swing high on January 8th. And yet again, SPY leading out with outflows of $674 on that exact day. And the final major high on 122, January 22nd, we had outflows of $1.5 billion from, you got it, the SPY. So we're seeing a pretty good correlation there between major outflows on the SPY and significant highs in the index, at least on a 1 to 2 week basis. So where are we at right now? As of Friday, what do you know? S&P 500 leading the pack with outflows of $754 million. So far, batting 100%, 4 for 4. Will it be 5 for 5? Dorsey Intel is definitely betting that the S&P 500 is going to be significantly lower to get back down into that value area around 2030, which is what the C-suite model is currently showing, 2030 fair value for the next 3 weeks. So definitely look for some pullback action due to money flows and also growing long-term downside pressure on U.S. equities. Also augmenting the bear case is some unresolved pressure in China's money markets. They continue to press 5% for the 7-day rate, with the short term in the money rate well above the other longer duration contracts. So until we get that coming back below those averages, those longer calendar contracts back down into about the 3% area or lower, still seeing signs of that international money pressure, which inevitably results in selling of more liquid assets such as U.S. stocks and bonds. So definitely watch out for that. In terms of relative asset performance right now, we've got our major assets and sectors ranked by 1 month performance. Apple doing very well still, although definitely slowing down. Russia number 2, oil producers and explorers doing well, Disney, home builders, consumer discretionary all doing well. Although right now I'd have to say the greatest value is still being presented by Russia and those oil producers. Whereas our laggards are volatility, gold miners, gold, utilities, U.S. bonds, U.S. long bonds, and right now it looks like the value opportunity on the short side is going to be in the U.S. long bonds and also potentially U.S. real estate, IYR, although we would like to see that below its 50-day moving average before we really move in aggressively short on that. And just to demonstrate, pair based on those two prospects. We've got RSX, Russia, over IYR, US real estate. Very nice looking chart here. Definite breakout with several daily closes, unlike what we're seeing on the US indices right now. Definitely want to see multiple closes to confirm that breakout. So very nice. We still have a ways to go on the upside to even converge with the 200-day moving average, and RSI is very solid up there at 65. And Tom McClellan gives us some further insight into what may be going on with the U.S. real estate market. It does look like typically lumber futures lead that, at least new single-family home sales, by about a year. And if we have that aligned futures contract, we should see a fairly large drop in those new home sales, which real estate is highly correlated with, and then possibly a slight bounce, something like a 50% retrace, and then headed lower again. So it does look like those new home sales in U.S. real estate did probably already peak out, which we did see around last summer of 2014. So from here, that entire asset complex is not looking attractive. Tom also points out the Architectural Billings Index, which is even more of a leading indicator than, say, construction jobs or new building permits, because typically the architects are involved at a very early phase in any new development project. So if we see their actual billings index starting to drop below its 6-month moving average, that is not a positive sign. In this particular case, the correlated variable is real US GDP on an annual basis, typically very well correlated. So we should look to see if US GDP begins to drop off following the Architecture Billing Index. And we'll wrap up with what our futures are doing right now. Looks like not a lot of movement in indices, although we are seeing one of the biggest performers so far on the open, natural gas up over 2%. That's typically a risk-off sign, especially if you compare natural gas performance to Crude oil performance right over here. If natural gas is outperforming, that's typically a bearish risk-off sign. We're also seeing the 30-year U.S. long bonds outperforming the U.S. 10-year note, also a bearish sign. Japanese yen outperforming the Aussie dollar, also a bearish sign. And Dow and S&P outperforming the Russell and the Nikkei, also bearish. And I think, what else do we have here? Soybean meal, also a big indicator right up here, majorly outperforming soybean oil, the finished product. So lots of different futures crosses there, all sort of pointing towards some defensive behavior. So be on your guard. DI is looking for at least a week or two of some risk-off behavior, so don't be fooled by the basically breakout, fake out that indices put in last week. Sell the news. As always, if you like what you see here, please like, share, and subscribe to my channel. Until we speak again, good hunting.